Well, hello and welcome back to our home buying workshop series. This class will be focusing on all things credit and how it impacts buying a home. By the end of today's workshop, you're going to have a deeper understanding of how credit impacts the home buying process and tools to help you get on the right track to buy a home. We're going to cover a lot in this workshop, and after the workshop, I will update your dashboard with today's recording. And if you don't have a dashboard yet, let me know and I can take care of that. So my goal is to keep the workshops to 1 hour, and we may wrap up sooner. We'll have questions and answers at the end, so please leave them in chat. I'll be checking them throughout the workshop, but I might choose to answer your questions at the end. After the class, again, you will receive that online dashboard, so save the link that is sent to you. I'll be updating it with each class as we progress with this workshop series. And you'll also find inside the dashboard different homework assignments that are optional, of course, and other information that I think you may find useful that is pertinent to each workshop class. And last but not least, please be sure to RSVP for each individual workshop. You can find the class at www.mortgageporter.com/education. Each link is different for each class. So just a quick introduction. My favorite part about my job is helping people become homeowners, and even more than that, learn about the process and the different things that is involved in becoming homeowners, because it does help you with other things in life, such as having great credit and budgeting. And I've lived most of my life in Western Washington. So in this picture is actually of me in Renton, a little bit younger, and taken off of Lake Washington. That's actually the old Boeing plant behind me. And I'm glad you're here today. So in the home buying process, after reaching out to a loan officer and learning about what your home buying goals are, one of the next steps may be reviewing your credit. And pulling credit can really make people nervous. It can make me nervous too when I pull my own credit or somebody else's, because you don't know what the scores are going to be. And these digits have quite an impact on our lives. And sometimes we feel like we don't have control over what those scores are. And even though you might know what your scores are from using different online credit tools, the scores that you get are different than the scores that I see as a mortgage lender. So I'm going to be sharing some tips with you today to help with this. And most lenders should be starting with a soft pull, meaning that it doesn't impact your credit score. They typically will pull just one or two bureaus, and a hard pull happens just before underwriting, and it may ding your scores. However, your scores should recover. Your credit score affects the cost beyond borrowing a mortgage. It impacts your everyday life. So sometimes just 1 point in your credit score can make a big difference in how much you pay for something with the interest rate, or even if you can get approved for a loan. It's really, it carries so much weight, like I mentioned, in your everyday life. And even many insurers, even for auto and homeowners insurance, use a credit-based insurance score to help set the rates and premiums that you pay. So better credit scores can mean lower premiums because statistically, people with higher credit scores file fewer claims. And as much as I don't agree with this, it is what it is. And so it does really help to improve your scores. And with credit scores, sometimes it's not even about the score itself, but the patterns of responsibility and reliability. And so, once a time before credit scoring, lenders would use your credit history and have to manually evaluate your credit score to determine if somebody was creditworthy. But it is really, I can't stress enough how important it is to try to have a good credit score. I mean, you could be exactly alike with the same financial qualities, same savings, same employment, same income. I mean, seriously, both be equally worthy of the same a loan program. But your credit score will impact what you pay for the same things: your home insurance, your insurance, your debts, and potentially even if your rental application is accepted. So, but one sister had a score of 750 and one had a 618 score. And we'll get more deep into this later in this presentation. But if they're putting 5% down with conventional financing, the difference in pricing with their rate would be 1.25% for the very same scenario. So if the sisters were buying together, they would have to use the 618 score and have a higher rate. So this translates to paying a 1.25% more for the same rate. And this is so if you had a loan amount of 400,000, that would be a cost of 5,000 more on having that lower credit score. So it is like it can be very costly, as you can see, to have a 618 score versus a higher 700 score. And so, what do you think is on your credit report? You can drop it in chat if you'd like. I mean, you may be really surprised to know that your names, your aliases, addresses, past addresses, of course, your social security number, and your debts, even open and closed accounts, student loans, judgments, repossessions, past due child support, alimony can be on there, bankruptcy, hard inquiries, and scores. Hopefully, some people don't have credit scores. And your information can stay on your credit report for 10 years or more. So here's an example of a credit report. This is not one of my clients. This is just a generic one. We can see here, the person's name, when it was issued. We can see the high balance limits, when the last time there was a late payment, how late a payment is, when the credit report was pulled. We can also see the collections, public record, inquiries, which, by the way, when you apply for credit, even if there's no payment due or if it's zero interest, it does show up as an inquiry, and you'll need to explain that to the underwriter, what the inquiry was for and if any new credit was obtained. So sometimes you can have a pretty long list with those. Hopefully you don't. Anyhow, that's just some of the, more of the information that's disclosed, including employment too. And sometimes the information is not 100% accurate, but before you make changes on your credit report, please talk to your lender. So credit scores, they can be as low as not having a score to above 800. And they are fluid or live, meaning that the scores change constantly depending on what's going on with your credit and how you're using your credit. So if you've made a payment, what your balances are, or even if you're just $1 over your credit limit, that will impact your score. So the biggest impact to your credit score is the payment history. This accounts for 35% of your score. And so one late payment, even if it's 1 day late, can bring your score down. So paying on time is very important. 30% of your score is on the amounts owed. So the scoring modules are going to look at if you're maxed out on debt. Your scores will improve when your balances are 50% below the loan limit and again at 30% of the loan limit. 15% of your score is based on how established your credit is. So credit scoring favors older credit versus new credit. So when you close an old account and then open a new account, like a zero balance kind of, trying to consolidate debt, that actually hurts your credit scores, which it shouldn't, but it does. 10% of your score is based on new credit. So that new credit actually brings your scores down, as I just mentioned, and factors into inquiries for credit as well. So so really watch out for those debt consolidations if you're thinking about buying a home. 10% goes to credit mix, meaning having it's good to have some revolving and installment debts. So if you miss a payment or are late on a payment, it can take 0 to 6 months for your scores to start returning back once you're current. And the later you're on your payment, the longer it's going to take. It can take 6 to 24 months for steady on-time payments to rebuild most of your lost points. And so it's really unfortunate because you can have this history of good credit and just miss one. Maybe you've gone on vacation or you just forgot, and it can really be dramatic to your credit score. So you can try reaching out to the creditor and ask them to, remove it. Some are real sticklers on it, and some might be flexible on it. But if you explain your case that you're trying to buy a home, maybe they will be kind and remove that from the credit bureaus. And when you're over your credit limit, it could take a few months or more for your credit scores to recover. So the longer your balance is over the limit, again, the longer it'll take to recover. So, and it doesn't matter if it's just $1. I mean, you've got to keep your credit under your allowed limit. When your balance exceeds your limit, it's your utilization is over 100%, which lenders look at as being high risk. And installment debts is kind of stinky. They don't give you credit for any kind of down payment. So a new installment loan is 100% utilization until you've made payments. So it can take you a long time to, for example, pay a car loan halfway down. And so if you've put like 50% down on the car and you have a loan amount for that 50%, it still is viewed as 100% utilization. So don't buy a car if you're thinking about buying a home. You gotta wait. Um, so lenders use what's called a mid score, which is the middle score of the three credit bureaus for the borrower. If there were additional borrowers or co-signers, then the lowest of the mid score is what all the borrowers is what's being used. And sometimes a co-borrower may be removed from an application if the credit score is dramatically low or if there's an event from their credit that may impact the loan. And sometimes that client can still be on the deed or title, just not the mortgage. Once their credit's improved, and if they one day refinance, they can be added to the mortgage if they want to be. But this also means that in this case, that the remaining buyer must be able to qualify with their income alone. So you can see here we've got two borrowers, and there are three credit bureaus that the lenders currently use. We're always looking at hearing that things are going to change with that, but right now this is what we have. And so you've probably heard of FICO, and that is Experian. There's TransUnion and Equifax. And so this first borrower has their three scores of 730, 727, and 744. And so their mid score is 730. The second borrower has scores of 803, 791, and 775. So 791 would be the score. We'd look at them, but if both of these borrowers are on the loan together, the lender is going to use 730 for their underwriting decisions and for pricing out the interest rate. So which is better, paying off debts or having funds for the down payment? You can drop it in chat. It depends. I mean, there isn't a set answer. And so I review the credit to determine what we can do to improve scores or if we need to build towards savings. And a lot of it is also going to depend on what the timing is of the person who is buying a home, if they need to buy now or if they're going to put it off for 6 months or a year. And some debts don't need to be paid off as far as, excuse me, a lender's concerned, including some installment debts and possibly medical collections. Established debt that has been paid on time is, again, very valuable to your credit score and should remain probably until at least after you've closed your home. So what are some common sense things that may not help your credit scores? And excuse me, what I mean by that is there are some common sense actions that can actually hurt your credit scores, like paying off debts or closing accounts or disputing items on your credit report. It all seems like the right thing to do, and oftentimes you might need to remove disputes when they from the lender may request that, and then that just cause your scores to go back up, well, go back down, excuse me. So always check with your mortgage advisor before making any changes to your credit, because things like what I talked about earlier, consolidating your debt to a zero interest loan when you had these high interest rate cards, different things like that can actually hurt you, and it can take a couple months for it to recover. So it is very important to make your payments on time. So what I do is I've set up auto pay on my credit cards with the minimum amount due. So I can always pay more, but at least I know that my minimum payment is going to be made and I'm not going to be late. And avoid getting new credit and credit inquiries if you are considering buying a home. And don't open up, like it says new credit or make any major purchases. Just always check with your lender and run it by them. It might be okay, or it might not be something good to do when you're getting ready to buy a home. And I know I'm probably being a little repetitive with some of this stuff, but it is so important. So avoid changes to your credit because it can take months to recover. And also, don't look at consolidating accounts unless you've been instructed to do so and you're planning on not buying for several months. Don't take out new debts. Co-signing on debts, that is a real big no-no because that is basically looked at as upon your debt. And if they make a late payment, it dings you like it's your personal late payment. And don't allow anybody to run your credit, even if it's like a zero interest loan or they, just don't give permission for that to happen when you're getting ready to buy a home. So paying off credit, like I mentioned, will actually hurt your credit scores. And it's possible that, like, if you're using cash to pay off a credit card or account, that maybe we should be using those funds instead for down payment, or maybe even paying off a different debt or paying down a different debt may be more impactful for qualifying for more home. So, best intentions and things that you think are common sense can actually hurt your scores. And paying off a collection. This is like, there's so many common sense things that really kind of, frustrate me with the credit scoring module, but that can actually hurt your scores too because the credit scoring modules treat that as a new activity to your collection. And so therefore, it's almost like getting a new collection all over again. So if we have a collection that needs to be paid off for a client that's looking to buy a home, then we often do that at closing through escrow so that the underwriter knows it's going to be paid off, but it doesn't have time to impact your score before closing on your new home. So that's something to consider. And there are some collections that lenders may not require to be paid off, like some medical collections. And this is a biggie too. New cars or even used cars can really ruin a pre-approval. So a new debt is one ding against you, like we talked about earlier. And like I mentioned, even if you're not financing 100%, like you have a trade-in or you put money down, the bureaus view that as 100% financed or 100% utilization of that loan or having a maxed out debt. And if you had a car loan previously that you on the car that you're trading in or that you had paid off, that's going to impact you as well because you just got rid of a nice established debt. So it's a triple whammy against your credit scores. And not to mention, if you take on like a $600 car payment, that equals about $100,000 worth of mortgage that you're no longer going to qualify for. So deferred payments are same as cash or pay as you go kind of things that are really popular right now. It's important to know that even though it doesn't appear in your credit report, it's something that is on your bank statement. Lenders are going to consider that a debt and factor that into your qualifying ratios possibly, or we're going to need to show that it's paid off. So I'm often asked how many accounts you should have, and ideally 2 or 3 that are 2 years old would be like nice. It doesn't always have to happen. It's not required. It'd also be great if it's 30% under the balance used, would really help your score. But again, doesn't have to happen. There are alternative credit options too. Having a credit card and just using it for groceries or gas and paying off every month can be really helpful for building credit. But please, again, talk to your mortgage professional before taking out any new credit. So if paying off debts, is it better to improve scores or reduce payments? And there's two different goals to have, and then of course there's also the goal of wanting to buy a home. And so we have to look at if we're trying to improve your credit score or if we're trying to improve your monthly cash flow. And it's most likely two different strategies that'll be based on what you're trying to do with your credit and what our goals are and what your whole financial picture looks like. And I cannot stress enough that everyone has a unique financial profile for buying a home, and it's also going to depend on how much funds you have for down payment too. So check with your lender. And if I had to give some basic advice on credit, I would say make your payments on time and keep your balances under the credit limit. Making a 1 day late payment drops your scores, or even being $1 over your credit limit dramatically impacts your scores as well. So any other strategies, I really need to talk to you to review your credit to give you more in-depth advice on credit. And you may remember this slide from our first class. You can see that these are just basic loan programs, the conventional FHA, VA loans, and jumbo loans. And the credit scores here, FHA, we're showing 580, and we can go lower than 580 too. So, and conventional or VA loans could be 620. We even have programs that go lower than that. They just wouldn't be, one of these programs. So there are other options available, even if your credit isn't perfect. This slide's just to illustrate the impact on credit compared to mortgage rates. And so there's a couple of factors that are going on here. One is the light blue grids are for loan amounts that have uh, greater than or less than 20% down. And the darker blue lines are if you have if you're doing 20% or more down. And you can see that the lower the credit score, the higher the interest rate is. And so it really does impact you with your payment, which you're able to qualify for. And so it's important, again, to have a good credit score to optimize it as much as you can. And this is probably a little too much information too, but it's like I shared the screen earlier with you. But just in the 700 credit score range here, from 700 to over 700, if you're doing you can see the different price points here. And so these are hits to fee or LLPAs, loan pricing adjustments. And so this impacts the price um, for the interest rate. And so just in a 700, even if you had 20% down and you have a credit score of 700 or higher, there's 5 different price breaks. And if your score is just like 1 digit off, that impacts your pricing. And then this also shows you that the higher the rate, the lower the loan amount for having the same payment. And so that's why, you really want to work on the credit. And so if you're trying to have a lower payment or qualify for a higher loan amount, we need to optimize your credit scores. So let's talk about dings or derogatory debts on your credit and things that can impact it. And these are things that I see most often. And so derogatory debts on a credit report can significantly impact your ability to qualify for loans or credit. And some aren't as bad as others, but what we have here is like late payments. And as we mentioned, if you miss a payment or make a payment after the due date, it is reported or can be reported as late. It doesn't always happen. It depends on how late you are and how picky the creditor is. But the longer the payment is overdue, the more it's going to impact your credit score. And with collections, if a debt remains unpaid for a certain period, it is sent to a collection agency, and that can severely impact your credit score. And who wants to deal with a collection agency? So that too can make it more difficult to qualify for loans. Or as I mentioned, we need to look at paying off some of them sometimes, depending on the type of collection, what the situation is after at closing. And bankruptcies can be one of the most severe derogatory marks on your credit, but it doesn't stop you from being able to buy a home, but it may delay when you're able to buy a home, or if you want like a better interest rate for buying a home. And a charge-off is when a creditor decides that a debt is unlikely to be collected, and so they charge it off as a loss. They write it off their books. And this is typically done several months after a non-payment. But those debts, those charge-offs can be sold to another collection too. So you got to be careful with that. Don't just assume that you're in the clear if that happens. And a judgment can take place if your creditor takes legal action against you. And that also remains in your credit report for several years, as well as tax liens. And so that can also really impact your credit. It's on the public record, and that you want to avoid that too, of course. And also, I kind of skipped here the repo with balance owed. This is something, it really makes me sad to see it when somebody gives up their car and as a repo and they think that all is good. But if there's a balance owing, that can still stay on their credit and impact them as if it was just a judgment. So you really need to check with the auto dealership and with the financer to make sure, get everything in writing if you're in that kind of situation. Also, as I mentioned, past child support may show in your credit report as well. That's due. So these derogatory marks can not only lower your score and increase your debt to income ratio, it can just, make it more difficult for qualifying. And credit too is cumulative as far as the risk is looked at with a lender. So if you have like one thing that's going on, that might not be so bad. But if you had like everything on this list going on a lender is going to be hesitant to provide financing. So if you do wind up with some of these blemishes on your credit, it doesn't impact you forever. So in fact, you can see that if you have a bankruptcy, if it's a Chapter 13, you can possibly buy a home within 12 months using an FHA mortgage. So that's a good thing. And we also have other resources out there that will finance before that time period, but your interest rate is going to be higher because it is risk-based and it would be considered non-prime. So, but sometimes, people can't wait 12 months to buy a home, and that's how come we have these different options available. So student loans have been really a mess since COVID. So there has been a lot of confusion on what is owed and what's not. And so it's really important to review your terms, and I'd say check your credit. So know your payment type, if they're income driven, if it's an income-driven plan or a standard plan, or if it's in deferment or forbearance, you're going to want to verify. Student loans may be potentially reported as late on your credit report, which is damaging to your scores. And these are just two different recent snapshots. The one with the Guardian is just from yesterday. So it's just an ever-changing situation. So stay on top of that with your credit. And the payments also will be factored into qualifying for your next home. Co-signing. I touched on this a little bit earlier, but when you co-sign on a debt, it impacts your credit as if it's your personal debt. So if the person misses a payment, you may not be notified, and this will impact your score as if it's a personal missed payment. And it also impacts how much you can qualify for with your next home. So it may not be easy to have your name also removed from somebody else's debt once you've co-signed for it until it's paid off. So it can really be tricky, and you'll see different situations where this happens. You think you're really doing a favor for a friend or family member, but it can really wind up preventing you from being able to buy a home. So really think twice before you co-sign. And, should you have joint or separate accounts with your partner? So, I mean, if your partner's trying to build good credit, it could be a good idea to add them to your established credit. However, it may be better to keep accounts separate in the event something happens to your partner. Maybe they lose a job or stop paying bills, and you don't know about it, and then it winds up bringing your score down. So having two separate scores helps to have options in case we need to not have one buyer on the mortgage. And Frozen credit. I don't know if you've heard about that before or not. It's not a Disney movie, but if you freeze your credit, it will need to be unfrozen for the pre-approval. I think it's a good idea to freeze your credit to help prevent credit theft. And it can be kind of a pain to unfreeze it and freeze it again, but that is something you need to be prepared for when you're getting pre-approved for a mortgage. So March of next year, or until March of next year, information is sold and resold by the credit bureaus when your credit's pulled. And it's sold to lenders who have to pay for leads in order to try to get business. And so you're put on what's called a trigger list. And you will be hounded. I've had clients say they've gotten 80 calls a day and text messages, and it's not the best practice. And so thankfully, this has finally stopped. And it's a good idea, but not until March. So it's a good idea to try to reduce the calls that you're going to get. And so I really recommend that you try to protect yourself from getting on the trigger list by visiting optoutprescreen.com and donotcall.gov. And that should help limit your exposure. And you can actually pull your own credit by visiting annualcreditreport.com. You're granted one free report from each of the three bureaus. And so I recommend using one bureau every 4 months just to make sure everything's in check. So after telling you all this, I mean, should you wait until your credit's perfect to buy a home? I actually recommend getting started with your credit right away with the pre-qualification. This gives us time to make any improvements that may help by the time you're ready to buy. It could take a year, or it could just be a few months. But if your credit's good enough to buy now, then we can still work on your credit so that your scores continue to be healthy even after you buy your home. And waiting could mean that home prices are trending higher, or that you missed out on a home that you'd really like to have had. So it's unknown where rates will be when your credit's optimal. And as an example, this is not a specific home, but this is For King County, a home price at 600,000, it's a forecast. So it shows that in just 1 year, it would appreciate by roughly, 31,000. And that's a potential benefit that you could have had by living in the home and buying it now. And we would, meanwhile, work on optimizing your credit. And should rates come down and your scores improve, that would be a double bonus and putting you possibly in a good position to refinance. And then not only do you have your home, you bought it at a lower price and you're able to follow rates down. And this is something, a strategy that people do all the time. So yeah, I don't recommend waiting if you can buy now and if you can afford to buy now and your right home comes along. So you might remember this case study from my last class. So when this couple bought their home, they had some credit issues, which is why we opted to use a federal way, excuse me, FHA mortgage. And they worked on their credit and it took a few months and then they were able to buy in 2019 and they paid 375. And we were able to refinance them later, but they were able to lock in the price of this home and gain the appreciation while they worked on their credit, which almost took 2 years once we were able to refi and eventually sell their home with a nice gain. So had they waited for 2 years to have optimized credit, that same home would have probably cost around 450,000 instead of the 375, and they would have lost that benefit of making payments to themselves and paying down their mortgage balance. So that's, again, I really do recommend looking at, at least starting reviewing your credit now and being prepared for in the event that the house that you want comes available, you're in position to buy it. And it's possible that, maybe your credit needs extra work. And, I never say it's a no, it's a, we're just not quite ready yet. And that's why it's great to get started early so we can work on creating a game plan for you. Because credit scores are just a snapshot in time, they're not permanent. So don't let that credit score get you down if it's not where you'd like it to be right now. So part of the plan for helping to get credit better, it could include reviewing your spending, which is a great thing to do whether you're buying a home or not. So we might look at options or things that can be that you shouldn't be spending money on. So you need to track what you're doing. Perhaps the funds can go down towards paying off debts or towards your down payment. So like right now for us personally, we are trying to figure out what TV subscriptions we can get rid of. So we're actually keeping a notepad by our coffee table and tracking what channels we're watching, and so we can make decisions on which ones to cut. So I mean, there's always something that can be budgeted out to improve your spending habits. And so I recommend making a list of what you spend, determining what your absolute needs are and what expenses you need, and make adjustments with what your want items are and the extras that you may be able to do without for a while. You can always add them back in once you're in your home. So, I review my bank statements, my credit card accounts, and see what I'm subscribed to and what I can cancel. So in the 50-30-20 rule is just a simple and popular budgeting guideline to help manage money. And by dividing your income into these three main categories. And so this suggests that, 50% of your income should go towards your needs, your rent, mortgage, your utilities, groceries, transportation, minimum debt payments, and your health insurance and cost. 30% would be on your wants, so more of your lifestyle type things, and 20% on savings, and including creating a emergency fund and retirement fund. So I know this has nothing to do with credit scoring, but it does with budgeting. And it's important to consider contributing to your 401k, even if you're not doing so right now. So if your employer offers a match, I mean, that's basically free money. And so if you're contributing to the match level, I recommend doing that. And if not, I would try to bring it up to that. And if you can't do that, just start with something. This is a pre-tax contribution, so you may not notice it as much as you think having that money come from your paycheck. And then check with your plan to see if you can withdraw or take a loan out against it when you go to buy a home, because that can be used towards your down payment. So it's basically a potential savings account for you to use for a down payment while also helping to build your future retirement funds. I mean, it's a great benefit to have if your company offers that. I also recommend making a list of your current debts and knowing what the interest rate is. I mean, this is just part of being financially responsible, whether you're buying a home or not. So I once had a ton of debt, especially when I was a single mom, and it was really hard to get out of. And so paying down your high interest rate debt may not be the best strategy that you need to take for qualifying, but it's important to have this information available for your knowledge, and so that if we work together to create a budget and a credit strategy, we'll have that information available. So I just pulled this today from Forbes, and credit card rates should start coming down with the Fed lowering the Fed funds rate. So it's going to depend on the terms with the credit card. But I mean, these are really high interest rates, and it can be really hard to get out of this kind of debt. And this is again from Forbes, and yeah, this is illustrating the total interest paid on this debt, and it really makes me sad. Once your balances get to a certain point, it can be challenging to get out from under that debt. So the strategy for paying down debt and for buying a home or improving credit scores is going to be different than just trying to get out of debt. And so that's just something to keep in mind, that the home buying strategy may be temporary, and it's something that I will help you, before home buying and even after, to help create a plan. This is just something that I'm very passionate about. So again, I can't say this enough. Don't make changes to your credit without talking to your mortgage professional. The things that you think make sense to do for your finances and credit may not create the results you want if you're planning on buying a home, and it can take months or longer to repair your credit. And remember our earlier case study. I mean, they did it. Their credit wasn't perfect. We created a plan. They bought a home using just their earnest money. So $2,500, and when they walked away with, 185,000 plus, what they paid down on their balances. And they got to enjoy living in their home while paying down their mortgage and having the home appreciate in value. And again, we're not even getting into tax benefits and all that stuff too, but it's possible. I have hope for everyone. And I'd like to give you a big congratulations. You are taking a step towards homeownership. And even if you don't buy and you're just working towards becoming financially ready, by learning about credit and budgeting, you're taking the right steps. And you're discovering that you don't need perfect credit to buy a home. And creating a realistic budget, setting financial goals are important. So I'm happy to help you with this if you need help. Okay, so for this week's homework, your assignment is to pull your credit from one bureau. You'll have the option of doing any of the three, but it's your choice. Review your credit limits and make notes of how much your credit limits you're using. So you'll figure out, like, if you're at a 50% limit or if you're over limit. But please don't make changes before reviewing your credit with me or your loan officer. And remember that paying off debts can actually hurt your score if you pay them off all the way. Common sense actions may not be what's best for right now if you're getting ready to buy a home. So, and I will be sending you a link with your workshop dashboard, which will be updated with today's class. And you'll see each module being added to the workbook as we finish each workshop. So, and it'll include your homework as well. So if your real estate agent referred you to this class, please let me know so that I can thank them. I really appreciate that they sent you here today. And our upcoming workshops, next will be the how much money you need to have for buying a home. And we'll also talk about down payment assistance. And then these are the upcoming scheduled ones. So we will also be having one on reverse mortgage coming up, which you may or may not be interested in. But if you know of anybody, please let me know. That'll be next Wednesday. Do we have any questions? All right. You don't have to wait for our next workshop to talk. Or to ask me a question if you have something you want to know now. And so just reach out to me. You can scan the QR code or call or text me or send me an email. I'm always happy to help you or anyone that you know with your home buying needs. I hope you have a great rest of your week, and I look forward to talking with you soon. Hope to see you at our next class. Take care. Bye-bye.